All right, thank you. Welcome everybody to our Monday Zoom and Learn. We have a awesome topic for you today that I'm so excited about, and we have a guest speaker that I will let Mary Jane introduce. I'm Tommy Dutcher. I'm the area sales manager for California Title, and my co-host is Mary Jane Morris.
Wasn't sure if you were finished there. Hey, I'm Mary Jane with Granite Escrow. I'm so excited to have our guest on today. Andrea Shoup with Shoup Legal is going to talk about Prop 19, but let me just say hi to my team real quick. Tracy Hasse from our Mission Valley office is attendance, as well as Jonna Ennis from our La Jolla office, and all our guests. We're so happy to see you. Yep. Before we get started, I put the statistic in the ad, but I want you guys to know this, that the largest transfer of real estate assets in American history is going on right now with the baby boomers. It is truly a victory in California that we were able to take it out of the county by county or the cross county and all the other variables that we had with the previous versions of this law I used to know the names of those props, but now I've moved on to Prop 19. So it's very important that we help seniors be able to, and their children and grandchildren take advantage of these tax savings. This is a giant, very important piece of real estate reality right now. And so I took the time to do some research, and I followed one of Andrea's classes before, and her comments after are always that she's helpful and cheerful and smart and fun. And I thought she would be just perfect for us. Andrea, welcome. Thank you for coming today. We'd love to hear a little bit about you, and then we're all ears.
Awesome. Well, thank you so much. I will go ahead and share my screen, and we could go ahead and get started. So I just want to make sure that technology is working. So can you hear me now? So I want to make sure everything's working okay. You guys can hear me. You could just tell me, yes, we can hear you. You're good. Okay, good. Cool. Awesome. I appreciate it. All right. So today, what you're going to be discovering is, go back. Basically, Propositions 13 and 58, what the law was, Proposition 19, how things changed on February 16th, as well as how to use LLCs and trusts to avoid paying higher property taxes in the future for either yourself or really for your clients. So this is for you if you advise clients who own real property in California. If you're confused on what Prop 19 actually does and how this can help and benefit your clients, and if you want to know what you can do now and you're confused about how or when to actually discuss this with your clients. So I'm going
Andrea,
to be
before we jump into that, can you tell everybody who you are, a little about your business, so they have that moving forward?
Yeah, absolutely. So I am Andrea Shoup. I am an estate planning attorney. I'm actually a certified specialist in estate planning, trust, and probate law. And I have an office here in Murrieta as well as one in La Quinta. And we focus on really protecting families as well as businesses with estate planning as well as business law. We do a lot of business succession planning. We also do trust administration and probate law. And we're really focused and centered on helping families and businesses understand what they need to know so they can best protect themselves. And so I think there's so much information out there. I mean, you guys are very, very fortunate. I love hearing what Mary Jane said. She knew that there was this change. So she went and investigated and brought information to you. So you're very fortunate to have Mary Jane and Tommy care about you to bring this information to you, because it's so important that everyone understands and knows about changes and information. And I love to get information out to everybody. So that's kind of a little bit about myself. Again, we have a law firm here in Murrieta with a satellite office out in La Quinta, out in the desert. All right, so let's talk about Prop 19 and basically what it did. and kind of when it affects people, when it affects properties, okay? And really it affects properties whenever there is a, basically whenever there's going to be a reassessment, right? And that's what we're talking about. We're talking about property taxes when properties are reassessed, which usually results in property taxes increasing, especially in today's market, right? We just see property values continuing to increase, and especially over the years, it's increased dramatically. So let's start there. When does property reassessment, property tax reassessment actually occur? So property tax reassessment occurs when property value is reassessed or it is revalued. And that happens when there is a change in ownership, okay? Change of ownership can happen for numerous reasons. Some of the more common ones is when there is a gift of property, whenever there is the sale of property. I'm sure many of you are involved in those transactions, right? Or there's a transfer because somebody has passed away. There's a transfer on death. And so because there is a change of ownership in those situations, the property will be reassessed unless there is an exemption. An exemption basically is a no, not me, because I have a really good reason. Okay, that's basically what an exemption is. It's just a way to say, yeah, that's the general rule, but I have an exception. I have a really good reason, so don't reassess me. Some common exemption reasons are when there's a transfer to spouses. There's still a very sliver of an exemption when you're transferring to children, when you're transferring to trusts, when you're transferring to businesses or business entities, and we're going to be talking about that one later on and how we're using that one to help avoid reassessment as well. And there's other assessment exclusions as well, but these are the most common ones. So that's what we're talking about. We're talking about property tax reassessment when the tax value is reassessed or revalued, and usually in an upward direction. So now let's talk about Prop 13 and Prop 58, because to really understand what Proposition 19 did, we've got to understand how the law was. So back in the 70s, Proposition 13 passed, and what it did is it capped when property taxes could be increased. Okay, it could only be increased by 2% a year. That's it. It didn't matter if property values increased more than that. And as we've seen in the past 12 months, property values have increased significantly, much more than 2%, I would say. So it's increased dramatically, but for property owners, and Prop 13, it was to protect property owners from those skyrocketing property tax values. And it limited that increase in their property taxes to only 2%. So the value could only be assessed up only by 2%. It also capped the property tax rate at 1%. So you'll see throughout my talk today, when I talk about property tax values, I'm always using 1%. And I know different areas of the state, different counties, different cities, different neighborhoods and cities, all of that, they have different actual, applicable property tax rates because of bonds and school bonds and all the rest. I get it, but we're just using 1%. All right, so that's what Prop 13 did. It capped when how much property taxes could increase each year to 2% a year. Proposition 58, it allowed a child to keep the parent's low property tax value whenever they received the property from a parent. So parents had a low property tax value because it was only increasing 2% a year. They could then pass that on to kids under Proposition 58. And as a bonus, we had Proposition 193. That was passed, that actually extended that parent-child exclusion, meaning parent or children could receive parents' low property tax value, and extended it to grandparents and grandchildren, which meant if a grandparent passed and they left the property to a grandchild, that grandchild could keep grandparents' low property tax rate. But here was the requirement: that parent, that intervening parent, right, had to have passed away. So if the parent had passed away, then the grandparent could pass on that low property tax rate to the grandchild. And so in practice, let's say mom and dad purchased that property back in the 70s and they purchased it for $40,000. The property is now worth $450,000. Well, the property is assessed only at $75,000 because remember, it's only increasing by 2% a year. And so taxes, that's only $750 a year. When kids would inherit the property, they would be able to keep that low property tax bill thanks to Propositions 13 and 58, because that is a pretty significant difference, right? $750 a year versus $4,500 a year. And remember, that's not just in 1 year, that's year after year after year after year of when that child was owning that property. That's a pretty significant property tax savings. And that, again, that was thanks to Propositions 13 and 58 under that old regime. I'm going to talk about how that's changed. All right, so one great thing and a way that Proposition 19 has helped keep property taxes lower is that it allows certain people to take that low property tax value with them when they move to a different house, okay? This applies to those who are 55 years and older, the severely disabled, the victim of wildfires or other natural disasters, okay? So if somebody falls into one of those 4 categories, over 55 years, the severely disabled, victims of wildfires and other natural disasters, then they are able to take their Prop 13 tax base with them whenever they move. But they can only do it 3 times during their lifetime, and they can go anywhere in California. Previous, under the old law, they could only do it 1 time in their lifetime, and they were limited to their county or a county that they had reciprocity with. Reciprocity means, basically it means, I'll do it for you if you do it for me, okay? So if somebody was moving from Riverside County to San Bernardino County, where there was reciprocity, at least I think there was, then they could take their low property tax base with them when they move to San Bernardino. Now, instead of just being limited to either your own county or a county in which your county had reciprocity, that I'll do it for you, you do it for me. Now people can go anywhere in California. It only applies to California, so we can't take it to a different state, but we can take it anywhere in California. Not only that, but they keep their current base value plus $1 million. That's incredible. So now if their property tax value has increased, they get that much plus $1 million. That $1 million is going to be adjusted either annually or every 2 years by the State Board of Equalization. It'll be adjusted up for inflation. So this is a great way that residents of California and the clients you are advising can take that low property tax rate with them when they move. So I heard Mary Jane talking about that right now with baby boomers is that something that this is the highest amount of real estate sales, something like that. Mary Jane, could you help me understand what you were saying with that?
I was reading a government survey that said, it was actually a couple of years ago, and then it was just repeated and reminded me that the largest transfer of assets is going ever in American history is going on in this graying of America phase, where the baby boomers, which were the largest generation for many years, have begun to enter the 3rd phase of their life, where they're offboarding assets and additional properties and things that, and taking advantage of their time and their money
Right.
to make a better life for themselves instead of gaining assets and keeping them. So
Right.
the government says right now the largest exchange of assets for baby boomers is going on. Right.
Well, and I think that's huge because as you're advising clients, this is the time to help clients understand how Prop 19 can help them when they're either moving into the county, as the buyer's agent, or moving out of the county as a seller's agent, or being any part of that transaction. I really believe that we can do so much good in just educating people and letting them know what's out there. Because if they don't know, then they don't know, right? We don't know what we don't know. So I think it's up to us. This is a way that we can add additional value to our clients and really to everybody that we can, that when we can give them this information and let them know what's available to them. All right, so this is how this works out in how this will work. Let's see. All right, so let's say somebody is downsizing. Husband and wife, they bought a home in San Diego in the 80s for $100,000. The current assessed value is $250,000, even though it's worth $1.3 million. Remember, it is only increasing by 2% a year. Property taxes is now $2,500, but they want to buy a home closer to their daughter. So they're selling their house and buying a home closer to their daughter for $6,000. The great thing is when they do that, they're going to continue to pay $2,500 in property taxes and not $6,000. This is huge for them because what an incredible tax savings for them. So they can have, downsize their home, take that lower property tax value with them, and still move to be closer to family. Now, and this applies again everywhere in California. So what does it look like when we're upgrading? So let's say that husband and wife, they purchased their home and it has a current assessed value of $300,000. Their fair market value is $1.2 million. Their current property taxes is $3,000, 1% of $300,000. They decided to sell their home and they're now buying a house in Carlsbad for $3.2 million. Okay, that first $1.3 million, that assessed value plus $1 million, okay, is taxed at $3,000. That's the current assessed value plus that $1 million. The next 1.9 million, that's the value of the home, 3.2 minus the 1.3 that we've already used, is taxed as it normally will. That's $19,000 a year. So that's a total tax of only $22,000 per year with Prop 19 versus it would have been $32,000 a year without Prop 19. Again, this is a huge savings for families and a way that they can keep their property taxes lower. And this is an opportunity for everyone involved in the transaction when we are working with, remember, you have to fall into those 4 categories: the severely disabled, those who are 55 years and older, the victim of a wildfire or other natural disaster. If someone falls into one of those 4 categories, this is available to them and they're able to take that lower property tax value with them plus $1 million and keep it. So remember this, and remember that you have the opportunity to help people to keep their property taxes lower when they're moving. All right, so now let's talk about kind of the other things that Prop 19 did, because there was unfortunately also a drastic reduction of that parent-child exclusion for primary residences. So remember we talked at the beginning, I said, yay, Prop 13 and Prop 58, because the kids could keep mom and dad's low property tax value, right? Well, that's significantly decreased now. Children will no longer inherit their parents' low property tax base. The only exception is if it was parents' personal residence and now it's child's personal residence. Remember, if it's parents' personal residence and child's personal residence, then it can apply. So and to be a personal residence, that homeowner's exemption must be filed with the county recorder, or not the recorder, but it must be filed with the county that it is the homeowner's exemption. And that must have been done for mom and dad, for the parents. And it must be done for parents within 1 year of receiving the property. The great thing is they can keep mom and dad's as a current assessed value plus $1 million. And that $1 million will get adjusted for inflation by the State Board of Equalization. Anything above that is going to be reassessed. So if it's mom and dad's personal residence and child's personal residence, this still applies. And this is how it works. So let's say we have a home and the current assessed value is $200,000. The current fair market value is $1.5 million. So we take that $1.5 million, we take off the current assessed value plus the $1 million is additional, and we have $300,000. The new assessed value is going to be that original $200,000, the $3,000, which is left off after we do our math, for $500,000. So the result is a partial reassessment to $5,000, but that's still great because there would have been a huge additional reassessment to $1.5 million. That's a significant savings for families. So thankfully, we still have that savings. Pre-Prop 19, it was an unlimited exclusion for transfer between parents and children for the personal residence. And so that did get limited, but at least there is still an exemption there. And then sometimes I've asked.
For non-primary residents, none of this applies.
Correct. Yep.
So let me ask one question while we're on that subject then. What if the residence is owned by a trust? The parent passed away, but in the trust will remain to own that property for life. It can never be sold. Would it since the trust owns it, would it still be exempt from a reassessment?
No, because the with the State Board of Equalization, county assessors, they look to who the who enjoys the beneficial interest of the trust. So usually that's somebody who either has a right to live there, right to income, different types of rights. And so who, even though the trust owns it, that's kind of a misnomer, because it's a trustee who owns it as it's an individual who owns it as a trustee for a trust. And so there's always a beneficial owner of the trust. Somebody who has a right to income or right to live in it, right to possession. And so the county assessor that's why they will look and ask for a copy of the trust so they can determine who the current beneficial owner is. And whenever that beneficial owner changes, then there is a transfer.
Okay, one last question on that. What if the parent has 2 primary residents?
I love that question. They can't. They can only have one because you can only file the home owner's exemption in one county for one personal residence.
So they better file it for the one that is worth more.
Yeah, I asked that. Somebody asked me, well, Andrea, I got 3 homes and I got 3 kids, and those 3 kids will use it as their personal residence. Very, very sneaky, but no go. It has to be parents' personal residence. They can only have one because they have to file that homeowner's exemption with the county, and it can only go to one child.
Gotcha.
Unfortunately. But yes, this is only for primary residence. And it could, because Prop 19, it completely eliminated the parent-child exclusion for non-personal residences. All rentals will be reassessed. Commercial rentals, that's all going to be reassessed. Industrial rentals, reassessed. Vacation home, that cabin, it's all being reassessed. Unfortunately, there is no exclusion for rental properties between parent and child. That all has gone away. And so the way
so when you get sick, sell them all off so that your kids get money instead of the tax.
Well, so I did not say that because there's a whole bunch of capital gains reasons why you probably don't want to do that. But there's different ways to do it, and ways that I believe people can really understand what they want to see done, achieve it, and minimize the taxes. You can't eliminate it, right? I mean, a taxing agency, they're going to get a part of it for the most part in some regard. But if you're working with a professional who understands and really understands what the family wants to achieve, there are some really cool things. And this is, okay, I have to just remind you guys, remember, I'm an attorney. I geek out on the legal stuff, okay? I just think this stuff is so cool. So I love to find like the ways that you can still do it and get the result you want and not have to pay all the taxes and stuff. Again, that's my fun part. I'm like, oh, cool, look at, we could do this, we could do that, and look at, we can still keep the house and do this and do that and whatever. So anyways, but I digress. So, but there is, I believe, a reason why there will be a lot more of sales of rental properties, either single family residences or multi-unit properties because of this. And let me tell you why I see that. So Tommy, you're exactly right. So let's imagine this rental property. So mom bought a fourplex back in the 70s. She purchased it for $100,000. The current fair market value is now $2.5 million. The current tax bill is $3,000 because that's the current assessed value of $300,000. If mom dies and kids inherit the property, the taxes increase from $3,000 a month to $3,000 a year to $25,000 a year. That's a lot. Remember, that's year after year after year. So for 25 years, this is what it looks like. Under the prior law, Prop 13, it would have been about $80,000 in taxes had it been mom's personal residence, okay? Paid over 25 years. Under new Prop 19, if it was mom's personal residence, it would have been about $280,000 in property taxes being paid. But under new Prop 19, for non-residences and rentals, it's going to be over $680,000 being paid in property taxes. So Tommy, I mean, I think you're exactly right. People are going to be selling this property, and they're going to need to, because the property taxes will increase so dramatically. And I foresee in my, my crystal ball, right? I just see people selling property more, but also I see rental prices increasing dramatically as well, because as the landlords and the landowners are paying more in property taxes, guess what? They're going to be charging higher rents to cover that. So I think we're going to have, unfortunately, another kind of result. As higher property taxes are there, we're going to see higher rental amounts to pay for it as well. So, but I think that this is definitely what we're going to be seeing over the next several years, because this is the law that's in place now. It's, it's done. It's all there. People ask me, well, is there a way to repeal the law? I'm sure there is. You can talk to, Sacramento legislatures to see if there's options available, but the law is a law, and it was actually a constitutional amendment by the proposition. So, all right, but I am asked, well, Andrea, what can be done now? I'm sorry.
I said, I think they did that on purpose. They made it sound like it was a good thing by clouding it, by showing, hey, with Prop 60 and 90, you were limited to what counties would accept the one-time transfer, and it was only one time. Oh, we're going to allow you 3 times now across the state. Made it sound really, really good. But on the back end, the tax liability is really, really bad.
Yeah. I don't disagree with you, but here we are, and this is what we have. And so,
and now we have Andrea, who's going to walk us through, when your clients are in this situation, finding ways of paying as minimal as possible.
Right, exactly. And that's really what it's about now, right? Is how can we minimize the taxes that our clients have to pay now? Because really, we want to be those superheroes for our clients. We want to do what we can to help them out. So what can be done now? I think it's really important. We've got to know the plan. We've got to understand what clients want to do. And we got to ask questions. Is anyone going to live in your home after you pass? If the answer is yes, and that someone else is going to live in their home and parents' personal residence, child's personal residence, then likely no planning is needed, because Prop 19 already provides a way for the child to receive the property, and a good portion of parents lower property tax rates. Another question to ask is, how likely is it that your kids will sell your property? If the kids are likely to sell the property, there's no planning that's needed, right? Because we're not concerned about ongoing property taxes of a property that we have sold. So if the kids plan to sell the property, likely no planning is needed. Ask, how likely is it that the kids are going to keep your property and use it as a rental, a vacation home, a vacation rental? Because if it's yes, then likely planning is needed. And if the property has appreciated in value, then likely yes. If the kids are going to keep it and the property is appreciated in value, then planning is needed. And by planning, I mean that's the legal structuring, right, or restructuring, rejiggering, if you will, of how property is held, so that we can have lower property taxes, and lower taxes all around, because it's not just property taxes. That's just but one tax. There's many different taxes out there. There's not just property tax, but there's capital gains tax, income tax, and so forth. So we really have to look at a lot of it and all of it to see what is necessary to work in that situation. But there is what we can use trust, we can use LLCs to structure a way for the parents to put something in place now to help the kids out later, especially when the parents know, oh my goodness, my kids are going to keep my property. They're going to be using it as a rental, continue using it as a rental. And I want to lower those property taxes for them in the future, because who wants to pay more in taxes, right? So we do use trusts and LLCs. We use them together, and I'm going to explain that. So again, I'm going to warn you, I am going to get into some kind of technical areas, but I think it's really important to understand it so you really understand how it works and how to use an LLC to a business entity like an LLC to transfer it. We usually use LLCs because it has a really good tax benefit as well. And this is more like income tax benefit. And so definitely talk with the CPA, whoever your tax advisor is, to help you make those decisions. It really is a combined joint discussion with everybody to make sure that it gets fully assessed and what works. And so let's talk about LLCs and how LLCs can help us. So remember, we were talking about when a change of ownership happens. Well, I can tell you when it doesn't happen for an LLC. A change of ownership doesn't happen when an individual transfers into a legal entity if the proportional ownership interests remain the same. Okay, what does that really mean? It means, let's say we have Main Street and husband and wife own Main Street 50-50. And now they're transferring Main Street into their LLC, and they own the LLC 50-50, okay? Because the proportional ownership interest remain the same, there is no change of ownership, okay? I'm gonna say that again. Because the proportional interest remain the same with Main Street before it was in an LLC and the ownership of the LLC, that proportional interest is the same. They're 50-50 of both. There's no change of ownership, but there's an asterisk for a reason, because it carries with it a taint. I'm going to talk about that in just a second, but just remember, when you do that, it's a great thing. It's very cool, but that transaction ends up being tainted. All right. Another really cool thing about LLCs with change of ownership. A change of ownership does occur when a person obtains control of more than 50% of a legal entity, okay? So if that LLC is transferred and somebody's receiving more than 50% of it, then there is a change of ownership. So that's why you've got to be really careful when you're working with LLCs. And this is why, I mean, truly, vesting matters. How you hold title matters. It's really important because it changes if there is a change of ownership or if there's not. If there is a change of ownership, there is a reassessment for property tax purposes. And so you have to be really careful with the transfers. Okay, so let me show you an entity transfer. Let's say an LLC is owned 90% by dad and 10% by daughter. The LLC then purchased Main Street. Remember, the LLC itself is purchasing it. We didn't have it transferring in. The dad dies, and now he leaves his 90% interest, and he wants to split it in half between his son and daughter. So 50% of his interest went to his daughter. She's now a 55% owner, and 50% of his owner went to his son. He now is a 45% owner. Is there a reassessment? Yes, it is 100% reassessed because the entity transferred to someone who now owns more than 50%. Because it went to daughter who now owns 55%. Therefore, it's 100% reassessment. With LLC transfers, the whole LLC interest gets reassessed, not just the amount that goes over. Unfortunately, it's kind of an all or nothing. So try that again. How do we fix that so it doesn't work that way? So let's say LLC is owned 90% by dad, 10% by daughter. It purchased Main Street, dad died, he left 45% to his son, who now is a 45% owner. And now he left 40% to his daughter. So now she's a 50% owner. And that other 5%, which he would have given to daughter, he's now going to give that to a son-in-law or a grandchild. Now they're 5% owners. That small little change, it means that there is no change of ownership, meaning no reassessment, because no one person received more than 50%. Okay, this is why it's important when you're working with LLCs, you got to be very careful with how you're doing those transfers. All right, entity transfer. The LLC is owned 100% by dad, and it purchased the Main Street. Dad dies and now leaves 100% to his only son. Reassessment? Yes, no?
Yes.
Yeah, 100% reassessment because one person received more than 50% of the interest, right? So what he could do is LLC is owned by 100% by dad. The LLC purchased Main Street. Dad dies, and now he's going to leave it 50% to his son and 50% to either daughter-in-law, grandchild, or something. And now there is no change of ownership because no one person received more than 50%. This is why it's very important that you're careful with these transfers. So let me talk about that taint. Remember I said when an individual owns a property, then transfers it to the LLC, there's no reassessment, right? But the property's tainted. It's this situation. Main Street, 50-50 by husband and wife. They transfer it into their LLC, but it's a taint. Why is it tainted? What happens? Basically, now when someone owns more than 50% or more than 50% of the property transfers, there is 100% reassessment. So not only when one person receives more than 50%, but if more than 50% of the property transfers, then there is 100% reassessment. So it's important to be aware of it and know how to get rid of it because we can remove it. But it takes a lot of steps. So what we do is, let's say mom has an LLC. She's 100% owner of the LLC. She also owns Main Street 100%. She transfers that property that she has into her LLC. So now Main Street is 100% owned by that LLC. So it's tainted, right? Because an individual with same proportional interest, it transfers, yay, no reassessment, but it's tainted. Okay, so that's what happened. The way we get around that reassessment when we transfer it to the children is we're going to distribute 50% of the LLC to a kid's trust. Okay, so the LLC is now going to be owned 50% by mom, 25% by son, 25% by daughter. Then we transfer the property in proportional interest to the owners. Mom now owns 50% of Main Street, son owns 50% of or 25% of Main Street, and daughter now owns 25% of Main Street. We have completely distributed out of the LLC. So now that taint of that LLC transfer no longer exists because we've transferred it out of it. So and then basically we rinse and repeat and we can transfer mom's other 50% interest. It's not as simple as doing it exactly that. So please don't try this at home.
Is it a better situation to form the LLC broken down by those percents? Say it's a son, daughter, and mom before the transfer of the property into it or after?
It has to be after because the transfer of the property to the kids will trigger reassessment because there's no parent-child exclusion anymore. We usually do this for non-personal residences, only for like rental properties.
Gotcha.
Yep. So you've got to just be very careful when you do this. You also have to protect against the step transfer doctrine that kind of clumps transactions together and says, well, it's just one transaction. You do this over a series of months, even over a year, and you're fine. You just don't want to do it like on the same day or the same week. So some people ask me, well, Andrea, come on, if I just transfer my LLC, how are they going to know? Well, because when a legal entity experiences a change of ownership, it must be reported, especially when it owns real property. Okay, so there is revenue tax code sections that say you gotta do it, and there are huge penalties if you don't. Penalties, it's not just like 10% of what property taxes. I mean, it's like 100% of the property tax as a fine, and so it is huge. And they go back years. I mean, I've seen it go back like 10, 15 years of when somebody didn't report a change of ownership, and the county's like, oh, well, that ownership change happened back in 1995. Like, we need that money. That's a painful tax bill. And unfortunately, isn't any reason for it or for non-reporting, that's money that has to be paid. This gets very expensive. And the State Board of Equalization, in all due respect, they're ruthless. Like they come out and they collect their money. So it is very important. You got to report it. So you can't just be like, oh, well, I just won't tell them. That doesn't work that way. Okay. So it also, when you are doing these types of transaction, using a trust is so important. So it's essentially, you know, like in that situation, mom is giving away her property. There's got to be limitations. We have to protect against creditor protection. Sometimes people are like, well, my kids, they don't have any creditors. They have great credit. They have stable jobs. Okay. What about their dog? You'd be surprised. I've had clients who were responsible for their son's dog who bit someone because son was on their property. Now they fixed that, right? After they realized, oh my gosh, I'm liable for it, but it's just something as simple as having a dog. Okay, also divorcing spouse protection, that's important. We need transferring and selling restrictions. We need all kinds of restrictions. Really, mom and or dad really want to still have some control over what happens with the property. So that's why using a trust is important. But you've really got to carefully evaluate the situation. This planning is not for amateurs. This is not a DIY project. And there really is no readily available, easy, oh, you always do this or you always do that. There's no easy solution like that because there's so many different topics to consider, including should you give away part of your property? What are the capital gains tax effects? What are the property tax effects? What are the income tax effects? What are the income effects, gift tax returns? So much. I mean, you really got to talk with a professional who understands and knows this. 4, agent professionals. When should you bring this up with your clients, and how can you help your clients? If you have clients who own rental properties, this is a great reason to reconnect with them. A great reason to go back and say, hey, I remember I helped you buy that residential rental property, or that commercial rental property, or whatever it was. You know what, there's this Prop 19, you should learn more about it, see if it affects you and your family and what you might want to do about it. Also, I will tell you, it is so important now, it's more important than ever, to purchase property in an LLC. When you purchase property in an LLC, the planning gets a lot more straightforward and a lot simpler than when you did it. So just keep that in mind when you're working with, especially with real estate investors, when even if they're just purchasing residential rental properties, they should be purchasing in an LLC. And I'm often told, well, Andrea, gosh, they haven't had the LLC for 2 years. They don't have like the income things. No. That doesn't matter. If you are purchasing in an LLC that the owner has control over, they can show income individually. The lender can work out all of those details, and yes, they can close on a loan, even if that LLC has been in existence like for 2 weeks. I know that because I've done it numerous times for clients. So please let your clients know that they should be purchasing an LLC. It's also important to understand, is a revocable living trust, is that enough? Many people say, oh, well, you know what? I got a trust drawn up a few years ago. I'm good. Andrea said something about using a trust. We're cool, right? No, a revocable living trust is not sufficient. It really is not applicable at all to this type of planning. It's very different. And so people are like, well, then what the heck is the point of having a revocable living trust? I will tell you, this is where my estate planning heart gets a little broken, but it's also an opportunity for me to educate, because there are so many reasons having a revocable living trust is still important for your clients. 1, it avoids court through the probate process. 2, it avoids court through a conservatorship. They save tens of thousands of dollars on legal fees and attorney fees and costs and so much more. They save 2+ years in court. They avoid family fights. They avoid uncertainty. They choose for themselves who gets to step in for them. And truly, all Californians need an estate plan if they're a homeowner or property owner of some sort. I would like to take this opportunity to invite you to join at our advisor network. You could be the first to know of updates in the law, be a resource, and we give resources to help and ideas to help for your business building. You have VIP access to our network through a series of events that we have throughout the year. You receive exclusive trainings for yourself. See, you guys are lucky. You had Mary Jane and Tommy to bring, you good information, and really having access to educational trainings is so important, but you also have access to trainings for your client. I have had agents tell me, Andrea, I would love to get this information on estate planning or Prop 19 to my clients. And then we work out a way like, oh my goodness, have them bring a friend, and then becomes a networking opportunity for you. So anyways, if you want to join, please just email info@shouplegal.com. Subject line advisor network. No, we don't spam you. We don't do any of that. We just give valuable information to you when it's needed. There's about maybe 1, maybe 2 a month. All right. Also, I would like to invite you to an individual strategy session with a member of our legal team. At the end of our time with you, with a member of our legal team, you will have personalized training to discuss these concerns with your clients, a strategy to protect your family, as well as a strategy to protect your business. How it works, it's a 45-minute meeting, either at my office or on a Zoom call. And during that time, we will discuss how to discuss these topics with your clients so that you're providing additional value to your clients, discuss your personal concerns and goals, develop a strategy to protect your family as well as your business, and plus we'll answer your questions regarding your unique situation. Usually this is a $550 value. However, because Mary Jane and Tom really love you and care about you, they have arranged for this to be provided for you free of cost. So I would say you guys owe them a big thank you for providing this for you. So usually, if you call, it's $550, but our strategy session for you is no cost. So how to schedule, message me, Andrea Shoup, through the, you can do it on chat, and just enter your name, phone number, and email address, and my assistant will reach out to you. If you find my name, do a direct message for me, then only I can see that information. What's the catch? I just have limited space. We always run out of time, available time. And so I have made my team available for limited time over the next 3 weeks for this opportunity. We usually always run out of those time slots. So you've got to let me know as soon as possible if you want to take advantage of this opportunity. There's no downside to you, but you just got to let me know like today, like right now, I see some chats coming through. So if you want me to have my assistant reach out to you, you just got to put your email address and phone number into the chat. Again, just message directly to me. So that's that. I hope that you guys have enjoyed our time together. If you want to call in, you can call in as well. Just give them code MJ15 so my assistant knows that you're calling in relation to this offer so that you're not charged that $550. All right. Questions? What questions can I answer for you?
Miss Andrea, I want to say that I took a snip of the screen where you taught how to be in the advisor network, and I put that in the chat for everybody. I also looked up the 2 articles regarding the graying of America, and it's $68 trillion of assets being transferred, and both those links are in the chat as well. My simple question is, I've been asking people when I know they're moving down, but because they're not buying up, there's no benefit to them on the Prop 19. Do I have that correct?
There is a benefit. There is a benefit. So they can upgrade. So they get their assessed value plus $1 million. So if they are
many of my seniors are downsizing though. So I wonder, is there anything I should be saying when they when their new tax bill is lower than their old tax bill because they've bought down so much?
Got it. No, basically they're already receiving a benefit, right? Because they have a lower tax bill because of the values. This really comes into play when people are, they've been in their home for like 30, 40 years. And so there's no way they're going to be, and their assessed value really is $80,000, $90,000. I was talking to a gentleman and he said that his parents purchased a property for like $15,000, $20,000 in the Bay Area. His brother inherited the property, had the low property tax rate, but he still, the assessed rate is only like $80 or 80,000, so $800. Well, that property is worth like $2.5 million. So there's no way that they're going to find an $80,000 property. So it's really for people who really are, they can't find a house, you know, they're lower than their assessed value.
And I just wanted to mention to you that I really was happy to hear you say that everybody who is a homeowner, even if it's a single home, has a trust need. And the reason that that comes to mind, and this has nothing to do with you, is an experience we had in town that because my husband and I are a second marriage, many of the things that we own are already have beneficial status and things they don't need to be in the trust to be passed. And we frankly, I'm just going to say it, we kind of got laughed out of the attorney's office. Like, you don't need a trust. There's nothing, you're totally beneficial. So I want to make sure that, you know, so now we're circling back, and obviously we're going to be coming to see you now. But we only own this single home. The rest of our assets are already preordained due to beneficial interest. But it's still important, even with the single home, because we both want our children to get a piece of it. We don't want them arguing.
Yep.
We want to avoid probate. There are many reasons to do a trust, even if you are a one and done home situation, right?
Absolutely.
I'll add something to that. I think it's important, even if you're not a homeowner. You could be a renter, but if you own hundreds of thousands of dollars in personal assets, you should have a trust.
Absolutely. You know, and I would say, Mary Jane, I would love the opportunity to, you know, have you sit down with a member of our team to discuss it. And sometimes we think, oh, we have beneficiaries on everything. It's good. We're fine. It's all good. Sometimes there's kind of hidden things in that you don't realize. So, but Tommy, I 100% agree with you. It's not just for homeowners. It really is if you want to make sure that you are protected when the time comes, because either we're passing away or we become incapacitated. If you have life insurance and you have minor children, when you have minor children, it's so important to have this done. And, you know, and Mary Jane, you're going to bring me back to talk about estate planning and all that. I mean, I could go off on this full tangent, but no, Tommy, you're absolutely right. It's important that you have this done, whether you are a homeowner or not.
And let's plug that right now. Andrea will be coming back, and MJ, you can alert to the date to go over estate planning, probate, and things like that as well here in the next, I think, the next month, within the next month.
Yeah.
I'm looking for that now. We are doing Monday, July 12th with Andrea again. I really wanted to tell you, the reason I told that story was not to, I didn't mention the attorney, but not to make it uncomfortable, but maybe not every shoe's going to fit you. You're going to have to meet with somebody who understands your situation and is really listening. You can get bad service anywhere, I guess is what I'm saying.
Yeah.
I'm having a different experience in this conversation than I had with a personal appointment. So we will definitely be bringing you our family situation looked at. And then I wanted to get, like I said, get back to the amount of transferring is $68 trillion in,
That's a lot of money.
in assets.
Yep. That's a lot of transferring going on. Any other questions I can answer?
Hey guys, now's the
I have a
time.
question.
Oh, go ahead, Daryl.
So what if we're working with clients with quite substantial assets that at one time had a trust, the trust hasn't been reinstated or haven't been updated? I have a few that have come into the office that, you know, their parents have passed and they're asking to do things. And you know, look at them saying, we can't unring the bell. You know, you should have done this 20 years ago. So would you suggest a review at some point?
Yeah, that's a good idea, because then they can know exactly where they stand and what their options are. Usually there's options of some sort, right? I mean, I just had a situation where I had to go to court and petition the court to change some stuff. Now, that's not what we want to do, but it's an option. And if it's a good enough reason to do it, then that's what we'll do. And sometimes it's a matter of, I just had a situation where the kids thought the trust said one thing. When we read it, we're like, no, it doesn't say that. It actually said nearly the opposite of it. It was just some misunderstanding with some of the language. And so I would definitely have them have it reviewed so that they can understand what their options truly are.
And we'll just, will we just refer the clients to your firm?
I mean, I would be honored to serve your clients. So I would be happy to help them. Yes, please do. If they call the office, please let them know that, that they are connected with you so that we know who to thank for entrusting them to us. But yeah, I'd be happy to help them.
Thank you.
Yeah, of course.
All right, any other questions for Andrea?
I feel so comfortable with real estate in general that I didn't think that impression could be improved, and it was today. I honestly believe that there are things, I was going to make it funny and say there are things I don't know, but it's a true one. There's things I don't know, and there are for you as well.
Well, likewise. I mean, put it this way, there's going to be a handful of people that I will be sending this recording to that I know need to see it. So,
because we're not speaking specifically, and because I'm aware of a couple of your situations, I do think you have a couple of large transfers that need to take a look at their whole package going on. Multiple properties, no matter how small the multiple properties.
sure.
Yeah, I thought that was an on-point question.
I have a question.
Yes, Don.
Yeah, if you now, let's say I put my property in a trust, is that going to be subject to reassessment when
For
you
yourself,
transfer?
yeah, probably not. It depends on the terms of the trust. But if it is a revocable living trust, which gives you the ability to change it during your lifetime, and it's for your benefit during your lifetime, then that should not trigger a reassessment. Now, I'm not giving you personal legal advice because there's so much about the trust that I don't know and so much about your situation, but transferring to a revocable living trust that you have the ability to revoke does not trigger a reassessment. It's not a change of ownership.
Okay, perfect.
Yep.
I send you, I send an email to a client of mine. She just inherited her father recently passed away, and she will be contacting you, I think.
I think we are all quietly emailing.
Yeah, I think the biggest thing with a revocable trust is that you are the trustee. If you're moving it into a trust where, let's say, your wife is the trustee and you are not, that could trigger a reassessment if she's not currently on title. So
It depends.
the
So
situation is specific.
it's very situation specific, exactly.
Can husband and wife both be trustees?
Sure. Yep.
Okay.
Yep. Yeah, I would make sure you're talking, whoever your estate planning attorney is that's helping you with it, make sure that they understand kind of the transfers and make sure that that they don't accidentally do something that will trigger or trip something, but we do it all the time. It's never an issue.
What is the approximate cost for family trust, revocable family trust?
It really depends on the situation and the family situation, as well as the number of properties, because as we know, each time we record something that's not our personal residence, on top of the regular recording fees, we got that $75 fee. So it just ends up being a little, additional cost. I really suggest do a strategy session with us so we can definitely sit down and talk to you and answer that question specifically for you, just because there's so many different variables. We have single people, people with children, people with minor children, we have blended families, where we've got his kids, her kids, our kids, and so it's just so hard to kind of say, oh, it's generally this, when it's just
Same reason that realtors are not allowed to give tax or law advice. It's not because we haven't been up against it, but because there's a bigger picture out there. You know, it's like an iceberg, 90% of it is buried. And you're only seeing this much of it. So even when
Yeah,
you
that's true.
know, you don't necessarily.
Again, for everybody that's on this session, I mean, Andrea gave you guys a free session. If you just put your information in the chat directly to her, one of her team members will reach out to you. You know, you have really nothing to lose and everything to gain there. I think that is the best thing that, you know, you guys that showed up today could ever do.
Thank you.
All right.
So Andrea, I want to thank you. I mean, again, it was enlightful. There were a lot of things that, again, you know, the smoke and mirrors, some of the things are great, right? With the Prop 19. And there are some that you should really understand how it affects your personal situation. And because it will affect everybody slightly different. And there's not a one size fits all there. And I think you really hit home with putting real life situations in front of people so they can understand it. And I'm looking forward to your next session about probate on the 12th.
Well, thank you so much. I appreciate the opportunity. I love sharing this information with everybody, and I look forward to seeing you guys then too. Have a good one.
Thank you.
Thank you, everybody, for joining.
Thanks. Bye.
Bye. Thank you.
Tommy and I stay on. He's going to end the recording. Tommy and I stay on until you are